Everything that's good economics is bad politics. And everything that's good politics is bad economics. That's the underlying problem with democracy and why they're usually as violent in their deaths as they are in their births. The dollar is starting off the year weak, which is the way it ended the prior year. And I think 2023 could end up being one of the weakest years ever for the US dollar. I think a lot of people piled into the long dollar trade in 2022 based on Fed tightening and the idea that the Fed was going to continue to ratchet up rates to bring down inflation, and that got a lot of people into the dollar. I think what's going to get them out of the dollar in 2023 is the realization that the Fed is going to give up its inflation fight, not because it wins, but because it loses. And it's going to focus attention on the economy, which is going to be in an even deeper recession. And I think in 2023, the recession deniers are going to finally have to admit the truth. And there's going to be a lot of pressure on the Fed to stimulate the economy, especially when we see a big increase in unemployment, which we haven't had yet, but which is coming. But the only stimulus the Fed has in its tool chest is inflation. That's all it's ever had. The only thing the Federal Reserve does when it wants to stimulate the economy is create inflation. Except the problem is now that inflation is the problem. And you can't solve a problem by creating more of the same problem that you're trying to solve. Gold stocks are going to do very well in an environment where the Fed is pivoted. And even if the Fed doesn't make a full pivot, it doesn't have to cut rates. It just stops hiking them. But I think more importantly would be quantitative tightening. If it slows down the pace of QT or actually goes back to QE, that is going to be, rocket fuel, I think, for gold. Because, the markets were pricing in this big reduction in the Fed's balance sheet. And I think the Fed is going to be even less successful shrinking it this time than it was the first time it tried. Remember, that when the balance sheet got to $4 trillion, they were supposed to bring it back down to $1 trillion. And I don't even know if they got below $3 trillion before they cranked it up to almost $9 trillion. And it's going to be harder to shrink a $9 trillion balance sheet than it was to shrink a $4 trillion balance sheet, especially when they're trying to shrink it in a much more highly levered up economy. The tech stocks are not cheap. In fact, despite a rather significant decline, they remain expensive. But I don't think that the next bubble is going to be in the same assets as the past bubble. So when the Fed tries to reflate this economy, I don't think they're going to reflate the tech bubble. We had a tech bubble 20 years ago in the late 1990s, and then we had another one more recently. But I think that this next time, the money is not going to flow into that sector. And I think one of the main reasons is going to be inflation. I think that tech stocks were part of the low inflation story. Low inflation meant low interest rates, and that meant that companies that were growth oriented, that weren't expected to deliver profits until many years into the future, when interest rates and inflation were low, investors were willing to wait. And they were willing to pay up for the prospect of a big payday in the distant future. But now, with the cost of waiting so much higher, not just the nominal interest rates, but the inflation rate. If money is really losing value much faster than 2% a year, you don't want to wait 10, 20 years to get your money. Who knows what it's going to be worth by then? So I think investors are going to be looking for stocks that can show them the money right now. So it's not companies that are promising earnings in the future. It's companies that have earnings right now and can deliver those earnings to shareholders in dividends, and dividends that can go up with inflation. People are going to be looking for the stock market as an inflation hedge to get out of bonds, to get out of cash. And they want real companies. They want companies with pricing power. That's important in an inflationary environment. You have to be able to raise your prices without destroying your sales. Now, a lot of companies are not going to be in that position. When they raise their prices, their buyers are going to go away. And in fact, even if they don't raise their prices, if your customers are spending a lot more money on food, on energy, on insurance, on rent, on taxes, and they have nothing left over, then it doesn't even matter if you cut your prices. You don't have any customers. So a lot of companies that have been living off of the discretionary income of the consumer, especially when the consumer had a lot of home equity, and could tap into it, or had the ability to buy now and pay later, had all kinds of credit, they could run up their credit cards. A lot of companies lived off of that. Well, they're going to die by that as well when the consumer can no longer avail himself of that credit. The last couple of times the Fed was able to orchestrate the pivot, it did it when inflation was 2% or less than 2%. And that provided the cover for the Fed. Hey, it's okay to do this because we have really low inflation. In fact, it's too low. And so we can kill two birds with one stone. We can stimulate the economy and get closer to our 2% inflation goal because we're going to stimulate the economy with inflationary monetary policy, which they claimed we needed. Of course, we needed it like a hole in the head because we don't need 2% inflation. Plus, it wasn't even 2%. That's only because they lied about it. They had a lie to get it to below 2%. It was actually probably 4%. And now, of course, it's double digit, although they won't acknowledge double digit because of the way the index is rigged. But my point is that let's say that we're back in recession, maybe even a financial crisis. We're seeing it in a small scale play out right now in crypto and blockchain, right? You're seeing all the dominoes, one company after another going bankrupt, freezing accounts, because everybody owed everybody else money. And there was so much counterparty risk, and it's this, and so everything is kind of imploding. But so far, it's kind of isolated, to the crypto. Yeah, you got Bed Bath & Beyond came out yesterday and they're filing bankruptcy. Of course, that was a meme stock. Got to $30 a few months ago. Now it's barely $1, right? But, you're mainly seeing this, collapse in crypto, although there's still a long way to go down because, Bitcoin is still trading above 16,000. So people are still in denial in the HODL gang. But what I think is going to happen is as higher interest rates work their way through the economy, you're going to see more problems in the credit markets blowing up, and it's going to be outside of crypto. Because remember, the mortgage crisis started with subprime. And when the Fed was out there saying, oh, don't worry, it's contained to subprime, I was saying, no, subprime is the tip of the iceberg. We're just seeing it in subprime first. It's the weakest link in the chain. But, we're going to see it in the rest of the mortgage market. So we're seeing the credit problems first in crypto because that's the weakest link. But you're going to see, broader problems throughout the economy because we've had 0% interest rates for more than a decade. You can't build up that kind of drug addiction and then, all of a sudden rates are 5%. And there's not massive withdrawal. So let's say we have another financial crisis, we're in a deep recession, but inflation hasn't come anywhere near 2%. I mean, maybe it's not 8%, maybe it's 4 or 5%, right? That's still well north of the Fed's so-called target. So what happens if in an environment where inflation is already double or triple the Fed's target, but then the Fed gives up the inflation fight and says, no, we got to stimulate the economy, and they stimulate the economy by creating even more inflation. Well, now they're throwing gasoline on the fire. And so now a high inflation rate gets even higher. And in that environment, I don't see financial assets as a group doing well. So I think bonds get killed. Instead of going up with QE, they actually go down. Long-term interest rates go up, which is going to be a huge problem. High multiple companies that lose money, these prices continue to fall. The stocks that go up are, again, the real businesses. That's why the Dow Jones was the strongest of the major indexes last year, because it has the most value, even though, on a relative basis, there's not a lot of value there. I mean, in an absolute basis, but relative to the S&P or the NASDAQ, there's better value in the Dow. Now, there's even more value, outside the United States. I mean, that's why, for example, our investment strategies, our two main strategies, dividend and value, both had positive return in 2022. And, they weren't huge returns, but we were in the black, and that's huge when everybody else is down 20, 30, 40%. To be up a couple of percent is a big achievement. And what made it even more difficult was that the US dollar was still up about 10%, and all of our stocks are foreign. So they had to go up 10% just to break even. And so our stocks did better than that. But I think 2023 is going to be an even better year for my investment strategy. I mean, I think it just could be phenomenal if we hit it on all cylinders, which I think we will, which will be a falling dollar, which is a big tailwind. But then we continue to see the rotation from momentum to value. and we're just loaded up with value and dividend payers. And I think the next rotation, which has just started and people aren't really paying attention yet, is from developed markets to emerging markets. And so, we've got good positions there. So I think we're set to where the money's going to be. I've been set for a while now. I've been anticipating this rotation for a long time. So, it's all